You're listening to the Real Estate Runway Podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today, we're going to have a veteran real estate investor here on the phone. He's a massive developer in South Austin, Texas, owns over 2,200 acres. This is Tom Staub, owner of Red Oak Venture Capital or Red Oak Development. Not only do they own an engineering firm that services all their projects as well as for hire, but they are one of the largest developers in the Austin, Texas area. So love to have him on the show, hear from his experience, and really see how he can help you as an investor. And if you're aspiring to be a developer, he's going to talk through the process of development a little bit for you so you understand what goes into it and what is important. Now, before we get into the episode, if you get any value out of this, please leave us that 5-star review and thoughtful comment. That's really the only way we grow the show and get to more people like you. So we appreciate you for that. If you want to be on the show, you can visit us at thequattroway.com/podcast to apply. And if you want to request a topic or just give us some feedback on the episodes, feel free to email us at podcast@thequattroway.com or leave it right there in the comments. We read every single one of them. And if you want to follow us on social media via our parent company, QUATTRO Capital, follow us at Team QUATTRO Capital, one word, no special characters, on Instagram, LinkedIn, and Facebook, or just visit us at thequattroway.com. And with that, let's get on with your scheduled production. All right, Real Estate Runway family. Welcome to another episode of the Real Estate Runway Podcast. I'm joined with a veteran real estate investor and developer today, Tom Staub with Red Oak Capital. Tom, welcome to the show. How are you today, brother?
Well, Chad, how's it going?
Going really well. And you know what the listeners don't see is we just came off of a whole bunch of technical difficulties to get this show to you. We finally got Tom's AirPods paired to his Dell computer. So maybe if we shame him enough in the comments, he'll go buy a Mac, but we'll work on that later. So.
Yeah.
Anyway,
I'm 38 and every week I get older and older with technology. So there you go.
Fair enough. Well, the good news is you're not in the tech space. You're in the real estate space.
That's
what we're
right.
going to talk about
That's
today.
right.
So, you know, Tom, before we get started, tell the listeners a little bit about yourself, your background, and what Red Oak has been up to, around Austin.
Well, a quick, anecdotal thing that I've heard. They say 85% of the time you end up doing what your parents did in some capacity, right? I grew up in Morgan Stanley finance my entire undergrad, grad, post-grad, went into corporate consulting, corporate finance, biotech, tech. Fast forward to today, I own a civil engineering firm called Viewpoint Engineering. We are the biggest developer in South Austin. And I say all that because my father is an engineer, construction man himself. So I ended up, following that 85% rule of thumb. So in South Austin, we have about 2,500 acres, give or take. And if you use the simple, density of 4 to 4.5 units per acre, it's about 8 to 10,000 units of homes over the next 10 years. Right. So we're very bullish in the South Austin market. Primarily, if you look at our portfolio, 80% of it in valuation is master communities. Right. And in those communities, it's not your slap and stick sort of 3-2 ranch. It's a variety of products. I was telling you, it's the entry level, it's the move up, it's the luxury, it's multifamily townhomes, BTRs, micro retail, med campuses, all of that. And then we have a variety of other, what we call now smaller communities, which is 200 to 400 homes or lots. And then we're also a fun project. We're building the biggest RV park in Texas.
I got to know, where is that RV park located?
True story. So anyone in this game of development knows that what I call the 3 variables of risk, CEP, construction, engineering, politics, right? So in-house engineering team, construction will be in-house come April. And then politics. I have a guy on our team from ExxonMobil who spends every day just schmoozing with politicians. So one of the county commissioners, I won't say the name, got defeated in the last run. And that person said, Red Oak's been great to work with. I'm going to do you a favor. Talk to my friend who owns 150 acres next to the flagship Buc-ee's. And for all you out there that don't know what a Buc-ee's is, wow. I used to make fun of it. It's a science equation. The owners have completely dialed in the perfection and optimization of a C-store. But anyways, you're talking 120 gas pumps. It's a $500 million company. They're mad scientists, which I very much appreciate. So we are adjacent or pretty damn close to the flagship Buc-ee's in Texas.
That is incredible. I said that we have some properties in Kerrville, which is just like wine country exploding, out there. So I didn't know if it was that direction. But yeah, for those who don't know Bucky's, he just kind of glossed over this because he's a Texan, but he did say 120 pumps. That is true. It is a massive operation. And I've never spent more money at one gas station in my entire life. So anyway,
it's amazing. Not at all in real estate, but if you go into Bucky's, again, entrepreneurs really appreciate this stuff. Yeah. Everything is private label. Everything. Right. So, they've negotiated every nook and cranny of that store to maximize profits, which is mind blowing.
Yeah. And this is, by the way, like bigger than a Home Depot. It's incredible how big these gas station convenience stores are, So anyway. Yeah. All right. Getting back into it. So, development in Austin, I mean, it's a fantastic topic. I love talking about building new product here on the show, especially as we've seen replacement costs start to be a lot more comparable with acquisition rehab costs. It's worth looking at putting money on both sides of the fence, guys. And so, tell us a little bit more about the projects that you're doing and maybe how you're putting these projects together. Where are you finding the land? And you have quite a bit of it already, but why South Austin? Why master communities? I mean, well, you're really spread out there. So what's going on?
Yeah. So when you look, really across the nation, right? Well, in most pockets of central and South United States, the scarcest commodity is water. Water is now gold, right? Sewer plants, also issues with the extensions of pipes, but you can always build those on site, get a permit, call it a day. So when you look at the Austin MSA and the corridor of the water infrastructure and where all the money is going, all the smart money of BlackRock and the big funds, it's all going south. And we sat down with these three firms that are really doing all this, and we're talking billions of dollars here, right? And we asked them, why are they going south? Their prediction is that the growth that happened going north, Round Rock, sort of Pflugerville, sort of that A, B class communities, they think it's all going south. So, and there's a number of reasons as to why. So they have pumped about $3 billion into water infrastructures over the next 10 years going south. So we knew this a long time ago. So we just followed the water, right? And one of the key metrics I'll tell you, today, the Austin MSA is about 2.2 million people. It's going to be 4 million people by the year 2040, right? That's a lot of people. We need homes. We think it's going to be south. The conditions of soil are somewhat prime in the south. The water access is somewhat prime. Sewers here and there. And land is relatively still affordable. When I say affordable, you're looking at $45,000 to $60,000 an acre, right? So on a per lot basis, that's $10,000 to $15,000 a lot. So we go south, following the water. How we find the land is we have an in-house land team. We do 9,000 calls a quarter. We find 120 leads. Of those 120 leads, we put 4 in contract. We take 1 down per quarter. So we have a very dialed in process to find the best deals.
1 in 9,000, folks. Do that math. That's incredible. It takes 9,000 leads to find the one that Red Oak.
Let me think. So this is funny. So back in the day, I got started in that because, we used to do like land wholesaling as a side gig back when it was hot. At first we had 3 VAs from like the Philippines doing calls, $6 an hour because that's what everyone else does in wholesaling. And then me being a mad scientist, I was crunching all the data. I'm like, wait, these are just terrible conversion rates. So I took a step back and I said, team, who's answering the phone calls on these calls? Well, it's always the male farmer, the guy who is, 50 years old plus, man from Texas. I'm like, let's be honest. Do you think he wants to talk to a guy from the Philippines? Probably not. Let's try something new. Let's hire Susie for, a simple name from Florida or Tennessee or Texas with a twang who has a, soft, charming voice and we'll pay her good money. And it's amazing what happened. Our conversion rates skyrocket, right? So now we essentially have these Southern belles calling these farmers all day long. They're just charming their way through deals. So,
well, and you can't underestimate that, especially in the South. That charm goes a long way.
Long way, man.
That's fantastic. Well, so let's kind of take it a step further. You're putting together these development deals, these master communities and things of that sort in the South Austin area. So how are you deciding what to build? What's really driving the decision-making process after you acquire the land?
It's a great question. So, I call it the entrepreneurial poison. If you're a good operator, you're going to get deals to your desk all the time, right? And some are going to stretch you beyond what you know. And it's really, the hardest thing is to say no to any of these deals. So we kind of stick to what we know. We know when we find a good site that's going to be prime for investor community. We know what a good cost basis looks like, which is, to me, is how you hedge against risk. And we know when there's a market that's unique enough to do something different, right? And so we kind of just played it in that realm. Now, for example, we have multifamily tracts and BTR, built to rent tracts in our communities. We don't play in that space, right? I would like to. I would like to do vertical and multifamily. I just don't know enough to do it, right? I would like to build out a 200 unit BTR site. They're great assets to hold. I don't know how to do it. So we kind of stay in our lane. We don't subject ourselves to the too many irons in the fire to stick to what we know. So when we find a site, again, cost basis is important, access to water and sewer and all of that. But then if we think it's in the path of progress, and if those things all check out, then we proceed in underwriting and go from there.
Yeah. So what happens to the pieces of your tracts that are, let's say, set up for a 200 multifamily development, 200 unit, parcel that out and sell it to another developer, or hire a fee-based developer to build that part of the community, or how does that work?
Yeah, it's more of the former. Yeah. So we, like up in Temple, we have 75 acres, great location, like 4 minutes from the new Facebook plant. We have a 19 acre multifamily tract. It's really 15 and a half because of an easement, but 15 and a half acres, you're looking at prime 300 to 360 units, right? Again, it's a phenomenal market because you have Fort Hood, the biggest U.S. Army base in the United States, I think the world actually. They're extremely short on housing. We know that. We know the numbers work, right? And so I would love to have that asset. Again, don't know how to build it. And so in that scenario, I think we're offering now it's about $14,000 a door for the land, right? So that one for sale. We have a 10 acre piece of commercial there, which is going to be prime for like medical offices, a C-store. It's right next to a 4-lane highway. So again, that one we're going to sell off that. I believe that one is about $4.5 a square foot. So now the rest are all lots, 291 lots. That's what we're going to develop and then sell off the builders, right? So to your question, generally when we think of mixed use is the right play, we go out to partners and say, hey, we're not trying to make a home run margin here. We just want to get a capital event, pay off the debt, pay off the investors, and we're willing to give you a fair price.
Yeah, that's really good. I think there's something to be said about not chasing every iron that you can put in the fire, right? But being really good at roasting this marshmallow. You know what I'm saying?
That's right.
Rather than dropping a few in the fire along the way. So a lot of wisdom there. So you mentioned the word investors, Tom. A lot of our listeners are passive investors. They are looking for ways to multiply wealth through real estate, hence the name Real Estate Runway. We're taking off and growing that wealth. So, how do you and Red Oak work with investors? Are you primarily sourcing capital from, hedge funds and larger equity groups, or do you also work with the individual investor, and how so in the process?
So crazy origin story. In my 20s, I refused to go out and network. I was like, I can do it from home. I don't need a network, which is hilarious. So I didn't until about the age of 28. And I grew up doing my own flips and, actually doing the work and everything else. But then I was getting good at what I was doing. And back in those days, I was selling turnkey flips. So I would keep some of the best, I was doing my own wholesaling to find the best deals, cherry picking the best for myself, selling the rest of the turnkeys. I used to have to sell the idea of a turnkey. It was a foreign concept to investors back in 2012, 2013. And in order to get money to do the flips, I would go out and I'd have to start doing coffees. And then I started doing conferences. And then in my 20s, I raised about $8 million of check sizes of 10 to 20K, which is a lot of checks, right? And
it's a lot of checks. Yep.
So just by nature, you just start to network. And, I think when I look at investments myself, I really care about the operator, how they underwrite, and kind of their history, right? And I think as we begin to get traction, you started making a lot of money. And we have 45, 50 investors still with us, still in that same bucket that we have made money for a decade, right? And so I will tell you, going into these bigger deals, even my first 2 communities I raised off of my own investors, it's just a lot of work. So in the last 3-4 years, I have a partner that runs all of our capital raising. I still keep those 45, 50 investors as part of the game because they're the first ones that jump on the bus. But we are now, I'll just be transparent. Generally, we work with investors that can write ideally $250,000 check or above. We have some projects that are smaller where we'll take $100,000 or above, but generally we're at $250,000 or above check size right now. So
Yeah, that makes a lot of sense. And so, do you typically bring investors in? It sounds like you're primarily in the land business, right? And then, some of that land gets converted after it's land developed, horizontally developed, gets converted into something that may get sold off and gives you a capital event there. But you're also probably for the majority of your land going vertical with, these master plan communities and things of that sort. So, what is, I'll say, the opportunity for investment partnership there with your group? And is it both and or one or the other?
Yeah. And again, transparency, right? There's enough money in these deals. And I think if you get with the right partnership, open book, everyone can make some money and just, you can operate as a true marriage, if you will. Yeah. So transparently, our blended cost of capital is 18%, debt and equity, not cheap, right? So a debt, depending on what vehicle it is, can be as low as 7, but as high as 12, obviously 1 to 3 points in origination. On the equity side, back in the day when I had no experience in land development, I had, offered 27, 30% pref returns annually. We're now in the low 20s, but our track record's phenomenal. We have, that CEP risk equation, we're primarily all in-house. So I am a madman when it comes to KPIs and controlling the risk. And so, generally we're at 20 to 23% pref returns, or I guess you could call it IRRs for our investors. Investors have a variety of ways to invest. Master communities are more, if you don't need cash flow, it's going to be big payoffs, 2, 3, 4 years down the road. If you need cash flow, which I think we all do in some capacity, we have RV parks. We are opening a fractional ownership model up in Flagstaff, which is going to be a pretty lucrative project. We're raising a fund for seller financing deals. And what that is essentially is we take a chunk of land, call it 30 acres, subdivide it into 20 to 30 lots, as minimal construction as possible, and then slice and dice it into 1 to 2 acres, sell them off, carry a note at 12%, and, share back about half the profits with investors. So it depends on your risk appetite. If you want something simple and boring and not sexy, but you still make 10% returns, lot financing. If you want cash flow with a little bit of upside, a little bit riskier, or, RV parks. And if you want something that's probably in the mid 20s, then you're looking at big communities with the most amount of risk, but within reason.
This episode is brought to you by Agora's investment management solution. Are you a GP or syndicator still using spreadsheets or an outdated investment management platform? Advance to Agora, the next step in investment management evolution. Agora's customers raise capital 40% faster and reduce operational expenses by 25%. With Agora, you can collect commitments faster, raise more capital by creating beautifully designed data rooms, public brochures, and automated subscription flows. Manage all your investor relationships efficiently with the most advanced investor CRM on the market. Delight your investors with a beautifully designed investor portal, which is fully customized to fit your brand and integrates seamlessly into your website. Distribute payments in a click directly from the platform, and automatically generate and send all the reports and statements your investors need. Agora is suited for all types and all sizes of GPs or syndicators, starting with an affordable $5.99 a month subscription plan. Click the link in the description to book a live demo and learn what Agora can do for your business. Agora, better investment management.
That's fantastic. And folks, I wanted to make sure to give that opportunity here. That this is an operator, or a developer rather, that is worth taking a look at from an investment perspective. If you're looking to get into development, remember, you have to go vertical. So it's not always going to be a cash flowing thing on the development side. Not necessarily really ever, but it is, it's definitely a lucrative way to grow your wealth.
Yeah.
So, that being said, Tom, I'd love to kind of to turn over a little bit more and kind of benefit our active real estate operators a little bit who might be considering what goes into the development process. So, maybe if you can take a couple of minutes and maybe specifically 5 minutes, right? And let's just kind of talk through, what does it take to develop a project from acquiring the raw land to selling the project to a prospective buyer or, just keeping it outright. Let's talk a little bit about the development process and then maybe also the capital stack that goes along with it and kind of what has to change along the way. Just love to hear your perspective, how you see it.
So, depending how you see it, at least 3, if not 4 key milestones in a project. And by the way, I will tell anyone here, if you're really looking into getting into land development, I don't want to scare you off. It's not like flipping. It isn't like getting a 4-unit building, doing some rehab and selling. It is a completely different beast. It is far more emotional. It is way more of a roller coaster. But with that, it weeds out a lot of the weak. And so the spoils are there if you get the right deal. So first thing is make sure you're working with a good engineering company. Like I started with a shoddy one. So, my dad always told me the lowest bid is not the cheapest cost. I'm like, what does he know? Right. Well, fast forward to today and, I poached some of the best engineers from Kinley Horn, right? Because I was getting great deals in my last engineering firm. But I had to restart anyways. So it's kind of like when you go to Home Depot, you're like, well, do I need the $30 hammer or the one for $8? Well, what do? You buy the $8 one that breaks, come back and buy the nice one anyways. So it's kind of the same process. So definitely find a seasoned, if you can find it, not a backlogged engineering firm. That's going to be hard to find. So step one, when you decide you want to be a land developer, there are sweet spots in terms of size, right? The metro communities generally start above 120 acres at the very least. And there are some economies of scale that are phenomenal with the metro community, but you need patient capital. You need very dialed in planning. And that's where the biggest spoils are. If it were me, I would look a little bit smaller, maybe 20 to 50 acres and try to slice and dice it there. And then make sure you have a thorough underwriting process. Again, just some of the things I've learned. I would never close on a deal unless I have runway to ensure that I'm going to get entitlements. I can't tell you how many people we get every month calling our engineering firm saying, Tom, I bought a bad deal and I didn't do any water studies. I didn't do any sewer studies. I didn't do a geotech and environmental. I mean, just the basics. So you should be spending probably 30 to 40K up front on just making sure you can develop, right? Have a conversation with the city. It's free. Say, hey, this is what we're thinking. We want to build 100 homes. Here's the lot sizes, just basic stuff. And what we do in our negotiation on the land, we put up usually about 5K in earnest money, $1,000 up front just to get the water study done. If there's no water, scrap the deal. Once we get that, then we throw more money to say, hey, now we're compensated. We'll throw up 40, 50K and, earnest money, additional 10K, give us 6 months to take a look. In those 6 months, so that's step one, right? You did your basic due diligence. Step two is that your engineering team is going to take a deeper dive into the risk to really understand what the chances of you closing are. Now, if you're a good negotiator, you're not going to close until you get step 3, which is preliminary plat. Okay. So that's the idea that you have this concept, you've had negotiations with the city about zoning and annexation, which means you're now part of the city limits. You've done your water and sewer capacity studies, all the basics, environmental phase 1, geotech, yada, yada. Once you get that all approved, they say, great, we like your concept. Yes, we'll approve the idea of it. The big one though is where, that's a big one. Where all the work comes in is the next set, which is about 6 to 8 months. With the city, you're talking about how you're going to build out the pipes, how you're going to build out the roads. What about right-of-ways of roads? What about traffic signals? All those kind of nuances. And then once you get that approved, final plat, then you can go get financing, shovel in the dirt, develop. And before all that, you're negotiating with builders or developers and everything else. And so you can see why a lot of this takes between 12 to 18 months before you're even putting a shovel in the dirt, right? Yeah. And then you got about 2 to 3 years of phasing of lots and everything else. So it's a long process, and what I will say is across this entire process, it really is about cash flow management. The best operators are going to have an absolute dial on their cash, what they're burning month to month. And when they're burning too fast, they'll negotiate ways to smooth out that cash burn. So in fact, I'll tell you, Chad, I think this year is going to be the year where, disorganized operators will go belly up because they did not play correctly on their cash burn.
Want to generate higher return and drive alpha for your commercial real estate firm? Now you can with Lobby CRE by 30 Capital. Lobby CRE is an asset management platform designed to manage and optimize cash flow for faster returns and more visibility into performance. Shift your strategy with the market, not because of it. Identify opportunities and mitigate risk now rather than later, and save more than 8 hours per week through automation. Click the link in the show notes to learn more and book a demo.
And I love that you just dropped that nugget right there because, regardless of what real estate environment you're in, the only way you get in trouble in this space, and folks, you've heard me say this time and time again on the show, is you run out of time or you run out of money, right? Profits are one thing, especially if you're operating a deal. You can be profiting all day long, but if you're burning more cash than you have in the account, cash and profit are not the same thing. You can't spend your profits. If you don't believe me, go to the grocery store and try to buy your groceries with a percentage of the profits from your company and see what they tell you. Okay. So anyway, so thank you for going there for a second, Tom. I really appreciate it. Such wisdom. And it is not for the faint of heart, developing raw land. Then it is a process. And, I'm curious to hear your thoughts on this before we get into the questions.
Yeah.
In my space, right, which is the operation of multifamily properties, and you may see some synergies here in your space. What happened in 2020? A lot of people were freaked out by the prospect of, oh my gosh, are people going to pay rent? Maybe I don't want to plow money into operating properties. A lot of money got plowed into development, right? And it takes, as you mentioned, 12 to 18 months to get the land developed, maybe another 2 years on a multifamily community, about another 2 years to build it, And so all of a sudden, we're seeing a lot of these construction loans and construction opportunities either coming to market or, being forced to kind of refinance when they're not even fully at CO for the exact reason you just mentioned. They're in trouble with cash, interest rate spiked on them, burn rate got too high, construction delays out the wazoo we know the supply chain problems we've all been exposed to the last couple of years. Just curious to hear, is your firm expecting any sort of, we'll just say special opportunities coming your way as a result of anything I just said? What are your thoughts?
Yeah, I think so. I mean, I have a call this week with a team that bought 3 bad deals. Now we're predicting them out of it. One of our operators came to us from a foreclosure and said, hey, Tom, help us get this across the finish line, loss mitigation. I'll tell you, we have, I don't know, maybe 10, 11 projects now. I have one that has had a year delay and we're low in capital. So I'm at a point now where I'm doing a refi with the lender, say, hey, look, can we negotiate to put all this interest in the back half of the profits, which is risky. And if not, and you run out of capital, I'm going to self-fund it. Because as you may know, one bad deal in this business, and if you burn your investors, your brand is pretty much tainted for, some time. So I would rather sink with this one is about $30K a month of interest over the next 6 to 8 months than risk losing my investor brand. So is it happening? Absolutely. I think everyone's at least having to reevaluate their project. Think about, okay, well, even if I can exit as time or at the previous timeline, are my exit valuations the same? Right. And so I think everyone is recalibrating their cap stack in some fashion. And if they're not, well, then they must have endless amount of money or just, they're in a foolish situation. So yeah, we are seeing, I think, opportunities in the market. I think you're going to see some come to roost here in Q3, Q4 this year. I do think commercial office space in the metro cities like San Francisco, New York, Miami, those places, that's where I think the biggest toxic asset target looks like. I mean, let me just say a little fact. There's 75 million square feet of commercial space in San Francisco. I believe as of March of this year, there's about 30 to 40 million square feet either in renewal or in vacancy, right? Now, from what I have read, and I called this a year ago, early on this, but if vacancy creeps up above 8% in commercial real estate, just broadly, it's upside down in the portfolio. So you're talking 30 to 40% vacancy. Now, even if they renegotiate their terms and try to keep people in their buildings, man, I don't know. I think that city is in a deep situation. And it reminds me there's a lot of videos out there of like parts of the outskirts of Kansas City, parts of Detroit, parts of Cleveland that had a similar situation where people left for crime and, regulation and taxes, and the city went to rot. And, it's a beautiful city. It'll probably bounce back. My point is, I think commercial real estate is going to have a massive opportunity. I don't know what it will look like or how, but that's going to be, I think, the toxic asset class of 2023, 2024.
I love when we all put our necks out there and say what we think is going to happen. We may be wrong, but the writing is certainly the writing is certainly on the wall, right?
I was off a year ago. On YouTube, people lambasted me for like, what you're talking about. I'm like, oh, I might not, but hopefully not.
Yeah. Well, fair enough. I mean, I was on record saying that we knew interest rates were rising. We really felt like, a at an all-in rate, a 4.5% to 5%, which is kind of where we're landing now. We thought that was the peak back then. And so it's okay. We all say the wrong thing. But anyway, well, let's hop right into these Quattro questions, Tom, and then we'll get you back to your busy schedule running Red Oak. So thanks for being with us today. First question, what is your superpower in this business or in your life, and how does it serve you?
Yeah, I mean, I have a phenomenal staff, a phenomenal team. It's not just me. I'm obviously the face, and I build the vision, but my team is just, they're really badass. And I think some of the things that we do every quarter for all you other developers out there, or operators or entrepreneurs, a book called Traction. I got it right there. In the book, there's a free survey called the EOS survey, right? It's pretty simple. I think it's 5 or 6 categories that helps you understand in your business where you're lacking, what you need to improve, and how you might want to improve it, right? And so we do all that among a variety of surveys. And, what makes us great is that we really dig in on data, whether it be the land team on data, KPIs, individual KPIs and data, overall company KPIs and data. So I think as a team, our superpower is we're just super dialed into the data and science, right? And so I think more than any other operator that I've talked to, we are just obsessed with measurement of whatever we're doing. And I think in this business, that is one way to be able to sleep at night, is to know where all the numbers lie across the entire operation. So,
yeah, I think it's incredible. And that is absolutely a superpower. I've talked to operators who have no idea, even what their burn rate is on a project, for example. So that's pretty incredible. Well, let's take it the other side of the coin, Tom. What is your biggest failure in life or business, and what'd you learn from it?
Yeah, it's too easy. I got a pond. This is what it is, right? If you're going to take the swings, you're going to miss some. It goes as simple as one of my first flips. I didn't do any inspections, and the entire floor was rotting. And so there's that one. Just even recently, I bought a fourplex, kind of for the family, long story. But one thing I always tell investors is when you buy and own a property, always do a cut through the main sewer line to get the branches out, because they break those pipes, and those pipes are old, usually iron or some sort of PVC, whatever. I just forgot to do it. I got busy. And just last week, I got a call from my tenant, hey, the sewage is backing up. I'm like, shit. And I knew what it was right away.
Literally.
I forgot to put a salt on the main sewer line. That's $18,000 out the door. So there's that, structuring bad deals. Now, what I say bad is what is normal today. So for example, every land purchase we do, we no longer rely on hard money at 12 or 13%, right? 65% LTC. No. We do seller financing on all of our deals, 5, 6%, they're 36, 48 month terms, interest only, and they're carrying 85% of the debt, right? That was probably the biggest, not mistake, but opportunity to change the cap stack, is that when you buy lands or anything, any asset, frankly, try to have the owner carry the note, and maybe even offer them a higher premium on the price to get that note, because your cap stack's going to be a lot leaner if you do that. So.
Yeah, it really does. And I think the biggest thing there is most people are afraid to ask. And so you miss 100% of the shots you don't take, right? So
look, there's always a deal somewhere.
Yeah. Fantastic. Well, so question number 3, here at Quattro Capital, sponsor of the Real Estate Runway Podcast, one of our 4 pillars is philanthropy. We love putting money back out into the world, services, times, talents. And you'd be surprised every time we mention a philanthropic venture on here. A lot of times we get reports in our comments or emails of, people giving on behalf of the guests. So, where's your heart at? What does you and your company do to kind of put money back out in that way?
Yeah. So, I have a few actually, again, if you come to our office, on our wall, we have 4 main core values. No, not one of them is monetary whatsoever. It's all about character, community, and the Japanese thing called Kaizen and everything else. So 3. So the first one is engineering firm, civil engineering. So we are currently, we're building a foundation for the recent flooding over in Pakistan, which if you look at the impact, it's 25 times more impactful than that of Katrina. It's a massive devastation over there. So we're going to pro bono go over there and try to help them with their water, because they have heavy droughts or heavy floods, and then they have these massive droughts. And a lot of parts of the world have that, where you can just essentially reallocate the water resource. So that's one of them.
Yeah.
We're, I'm always blown away at how just like neglected our teachers are. I mean, it's unreal. I have to tell you, I've been in line for 2 years trying to get my boy into a Montessori. So what in the world? So anyways, so what we're trying to do, I mean, I didn't even thought about opening my own Montessori and like bringing parents to the table and just, it's like, what, so one thing that we're doing in our mesh communities every year and each one. So, well, first off, we're donating land in schools. So 20 acres to the school district in one, 40 acres with another. And then part of the contracts with builders, if they want to sign up to play, they have to donate selling at cost 10 homes per year, right? So now this is across all builders. So if we get 5 builders, 2 homes per year. We enable that by giving our lots at cost as well, right? So a teacher can live in an actual community. They can buy a $500,000 home for $350,000, right? If they go somewhere in that range. So we're going to start with a company called Homemade. It's a nonprofit where we're going to really get this out there and hopefully push a PR event to make this nationally known that, hey, we can begin to help teachers with their actual life in other ways than just, putting the bill for some tax credit. So teacher housing, that's a big one of ours here as well. So.
Yeah, that's just incredible. Thanks for sharing your heart there, Tom. So, before we get out here, what's the best way for our listeners to get in touch with you, whether it be for what you just talked about or to invest or, something of that sort?
We're, I'll tell you, Chad, we're always happy to help people out. Our engineering firm, any developers out there that are fed up with the engineer, give us an email, tom@redoakbc, like VictorCharlie.com. I can forward you over to them. They can handle you. And if you want to invest, I think the first thing is a call. Again, email me and we'll show you what we're working on. And if you really want to get involved, there's a lot of ways to do so. So.
Fantastic, folks. And as always, scroll right down to the show notes and whatever you're listening to this on, and his information will be right there for your clicking pleasure. Okay. So with that being said, Tom, thank you for coming on the show, sharing some of your expertise, giving us some of your valuable time. And we hope you enjoyed your time here at the Real Estate Runway Podcast.
Yes, sir. Thank you.
All right, everyone. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out. All right, Real Estate Runway family. I really hope you enjoyed that episode with Tom Staub of Red Oak Capital. Just fantastic experience as a developer in the Austin area. So if you want to reach out to him and see about investing in his projects or hear more about what they're doing from a philanthropic venture space, scroll right on down. His contact information is in the show notes. And folks, if you got any value out of that episode, please leave us a 5-star review and thoughtful comment so we can reach more listeners just like you with information like this. If you want to follow us on social media, Team QUATTRO Capital, one word, no special characters, Instagram, LinkedIn, and Facebook, or just visit us at thequattroway.com for some little buttons you can click to get right there. We really enjoyed the episode with you today. Until next time, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team QUATTRO can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.